Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this evening, the 28th of April, market closed. Welcome to the April conditions and market conditions impact conversation. I look forward to briefing you on how we are seeing the environment out there. Allow me to share the screen, and we will get right to it. Okay. So let's just go to the first one. Here we go. Okay, 40-year regime change. So we've been talking about this for a number of years now, about 2.5 years, that there was a regime change it's very important. Over the last 40 years, the markets have enjoyed an unrelenting decrease in interest rates. Some of you may remember in 1982, we had hit as much as 16% on CDs, riskless money, a CD in a bank, right? 16%, and it gave you a toaster to boot. So, and then of course, 40 years later or so, 2020, we're at zero. We believe the Treasury and the Fed's machinations during COVID, probably important to have them done, but they didn't pull it back fast enough, which gave inflation the ability to stick. And we believe that was the beginning of a new regime, where inflation is no longer going to be coming down, and therefore giving the ability for the Fed to continue to reduce interest rates, and frankly, just the opposite, as you'll see in a moment from a different slide. So the reason why inflation had come down so much in the 80s, 90s, and 2000s for the last, nearly 40 years was a confluence of events that are unlikely to be repeated, right? We had globalization. We essentially outsourced inflation to various other countries. The emerging markets were born during that period of time. They didn't exist before then. They weren't, we were producing the goods then. And by outsourcing it, by globalizing it, clearly it was disinflationary, and it allowed the United States to benefit as well from that growth of those countries and the purchasing that they did of our goods, as well as the lower cost of producing those goods. The collapse of the USSR. When that happened, they flooded the world with oil and gold, and that reduced the price of those commodities. Disinflationary. Technology. What bigger agent of disinflation is there than technology? The productivity enhancements and such. And of course, we had immigration policies and women coming into the workforce, which lowered the price of labor. So this was all disinflationary, which gave cover to the Fed to allow them to reduce interest rates consistently from 16% in 82 to zero in 2020. And when the price of money, that's what an interest rate is, the price of money comes down year after year after year, lots of good things happen to investors. Multiples go up, M&A happens, no one's worried. Any problems, just cut interest rates. If the Fed's your friend, and the Fed put, and these types of things. So consumption goes up. People are spending on, getting free credit card, zero interest rate kinds of deals. Housing goes up, M&A goes up. All good things happen when the price of money consistently goes down. Well, folks, we think that things are changing, and that 40-year run of disinflation and lower interest rates has come to an end. And we believe that has implications for investments. And if you could see it early, as I think we have been, you could set up your portfolio to benefit from that. So, sticking inflation. Two things there. Second wave, cyclical. There's a strong historical precedence that states that once you hit a 6% print on inflation, you're very likely to see a second wave, right? And that's happened in the previous periods of inflation, right? We'll see that in a moment. That's cyclical. we've also identified three secular reasons why we believe inflation is going to continue to be robust. And those are the reasons as follows. Decarbonization. Hey, let's save the world, of course, from being burnt. I get it. But in the same token, we need to make sure, I mean, it will be expensive to do. We haven't invested in the necessary requirement, the products like copper and silver and aluminum. The supply of these important materials are needed for the electrification. So without that, it's going to be expensive to do. Deglobalization, just like we said before, it's the opposite now. It's tariffs, inflationary. And then the big one, of course, is the debt, $36 trillion, deficits, 6.5%. This is also inflationary. So because of that macro in sticky inflation call, we see interest rates staying higher for longer. Doesn't mean they have to go straight up, just they're going to be persistently on the other side of 4%, let's say, and unlikely to ever go substantially below that, unless we have a very bad recession, right? So the point is that we're in a new zone, a new regime, and that has implications. We talk about real assets and gold, which has been a big winner for us, this year and last year. Economic turn in Europe, we believe that's beginning. We're seeing some opportunities there. Valuations are still in the high end of historical levels in the US, not so much as you'll see in other countries. So how do we navigate these waters? What's the playbook? More active, more engaged, know what you own and why, understand the underpinnings of that investment, and to do so with strong understanding of why you own this. Again, deglobalization, near sourcing, near shoring, labor strength, all inflationary. What's the prescription? More value, less high multiple growth stocks, more active and tactical management, perhaps more resource-based companies with pricing power, commodities, and those types of investments, which have not been in favor for years. And we're cautious on bonds and high multiple stocks. Here's a depiction of inflation. I call this your father's inflation because you can see, here's that double peak, that second wave I talked about in the 70s, right? Here's the first print. Everyone sort of relaxes a bit and they go right back up again. And then we get to a point of that disinflation run, that 40-year run, right? Well, we just think that that's done. It's over. And the reasons I just mentioned, the deglobalization, the decarbonization, and the deficit and debt issues are part of the reason why we feel that way. Here's the debt and the interest expense. You'll see here the green line, the green columns here are the interest expense. This is as of the first quarter of 2025, so it's not a full year. And you could see here, here's the average interest rate. So substantial interest expense and worrisome to say the least, and inflationary. This is a nice side-by-side graph that we like to show. It shows you that differential between the 40-year disinflation run and this new period, this new era, this new regime. And you could see here things like free markets and regulation to solving climate change, supply chains, just in time, supply chain resilience, and of course nearshoring. And here's that right here. So interesting how you could see that side by side. It's intriguing. But this graph I think really speaks to where we're at on the currently. Here you see the 36 years prior to the 82 top, so to speak, on interest rates. And this is the post-World War II period, right? the 1950s into the 60s. And what happened? Well, you had interest rates going up, as you can see in the red line here, for 36 years. What did the S&P 500 growth rate do in that same period of time? This is the 10-year Treasury, by the way. 5.7%. 5.7% compounded annual growth rate for the S&P. Okay. What did it do when interest rates went straight down for 40 years? Double. When you have lower and lower interest rates at your back, stock prices do better, period. So this is what we're saying here. Well, I'm not going to suggest we're going straight up on interest rates, but I'm going to say that we're not going down again. And to that end, I think that that has implications on how one manages their portfolio. So how are we positioned? Overweighting cash, respecting volatility. We're using the cash as markets are volatile and remain patient for the best price levels. Active management. Number two, fixed income is no longer the ballast it once was, and we need to be cautious of that because here you are, you're buying fixed income and then rates are going up and the fixed income is not performing. And frankly, after a 40-year run, they deserve to have a little bit of a flatness or not doing as well. So we're underweighted on fixed income. Dividend growth, value, high free cash flow yields, that's where we're putting some capital to work. Those are the kinds of investments that we feel comfortable with in this environment. Also, inflation-centric sectors like real assets, infrastructure, and resource companies. You talk about the water sector, the pipes, the pumps, the valves. These companies are strong, all-weather companies. Now, on the opportunity situation, we are talking about international equities as a market cap of the MSCI World Index. And look how far that's come down. Look at how far that's come down. That is an opportunity to look at international equities as a percentage of market cap. And that's an important statistic to have. So this tells me that international equities are cheap. Because look how far they've come down as a percentage of the S&P of the MSCI World Index. We also think that we're seeing an inflection point now in international markets where non-US stocks have bounced off their low faster than US. They're doing better. Now they're beginning to move for the first time in years. We think international stocks are intriguing. Emerging markets are also intriguing. And this slide speaks to that. Now, here's the thing you have to think about. When the dollar was weak back in the lost decade of 2000, 2010, the MSCI Emerging Market Index was up 210%. And that's the same period when the S&P's done nothing. So when the S&P did nothing, emerging markets flew because the dollar was weak, in part. Today, the Emerging Market Index is trading at a forward PE, assuming forward earnings of 11.3%, probably half of what the S&P is, and the annual earnings growth rate of 13%, maybe even 50% more than what the S&P is. So it would suggest that emerging markets, and supporting that, of course, is the negative sentiment out there on emerging markets. It would suggest the emerging markets are an interesting idea right now. So keep that in your on your to-do list or your watch list. Tactical allocation, active management. This is a chart. I know it's busy and hard to read, but what the red indicators show are the low in every year, and the green is the high in every year. And of course, the bar is where it closed. So what it shows you is that you have an opportunity to outperform by being active, by being tactical, by being patient, waiting for that proverbial fat pitch for your clients. We speak about commodities because we think that they are not only an inflation hedge, but they're cheap. And they have been because they really haven't done very much for many years. And so the cycle is positive for commodities right now. And the underpinnings, the economic underpinnings, ergo inflationary pressures, are also positive. And then finally, dividend growers. This is a beautiful area to invest in. These are great companies growing their earnings, growing their dividends rather, consistently, many times over 25, 30-year periods consecutively. But look how poorly they've done in the last 10 years or so. I think that's an opportunity that we should look at, and we are. So that's where we are today. I appreciate the time that you're spending with us today for this quick briefing on how we're seeing the conditions in the market. Feel free to reach out to us at Align Wealth with any questions or comments. We're happy to chat. Thanks very much. Talk soon.